Quick note before we begin. This video is educational analysis of historical data only, not financial advice. Always do your own research. You set your stop just under an obvious low, a safe spot, you think. Price drops, spikes clean through it, takes you out, then instantly reverses and runs without you. It feels personal, like the market hunted you. Here is the honest truth. It sort of did, but not by magic. That spot felt safe to you because it felt safe to thousands of others. That is exactly where the stop losses pile up. Let us look at the real data. Strip away the jargon, and liquidity is simple. To buy or sell instantly, you need someone on the other side. Liquidity just means a pool of resting orders waiting to be filled. And those orders are not scattered randomly. They cluster in obvious places. Think about where everyone puts their stop loss, just beyond the recent highs and lows, because those look like the safe lines that, if broken, mean you were wrong. So a big shelf of resting orders builds up above the obvious highs, buy-side liquidity, and another shelf builds up below the obvious lows, sell-side liquidity. Picture two magnets, one above price and one below. That resting money is fuel, and price has a habit of reaching for it. Once you see it this way, a lot of confusing wicks start to make plain sense. The liquidity sweep is the move everyone means by stop hunt, and it has a clean, repeatable shape. 1. Price drifts toward an obvious low where a shelf of sell-side stops is resting. 2. Instead of stopping politely at that low, it spikes just below it. A sharp wick that pokes under the level, triggering every stop loss sitting there and filling the big orders that wanted a cheaper price. 3. With those stops taken and the fuel spent, price snaps back above the level and reverses, often hard. That long wick poking below the low and closing back above it is the fingerprint of a sweep. Not a mystical manipulation, just a lot of orders getting triggered in the one obvious place they were all hiding. Learn that shape, and you will start noticing it on almost every chart you open. Take the first side on its own and make it concrete. Sell-side liquidity is the pool of resting orders sitting just below an obvious low. Mostly, the stop losses of traders who are long and tucked their stop under the level, plus a few breakout sellers. The more times price bounces off a low, the more obvious it becomes, and the more stops pile up beneath it. Here it is, for real. In January 2021, Bitcoin had built an obvious floor around $30,000, a level everyone could see, so a thick shelf of stops sat right beneath it. Watch what price does when it finally reaches down. It does not bounce politely. It spikes straight through, dipping below 30,000, triggering every stop hiding there. That is the grab. Then, with the fuel taken, it reverses and runs about 15% higher over the next couple of weeks toward a new all-time high. That is sell-side liquidity in action. Now the exact mirror, so take it slow and watch it flip. Buy-side liquidity is the pool of resting orders sitting just above an obvious high. The stop losses of everyone who is short, plus the breakout buyers waiting above the ceiling. Same idea upside down. The more obvious the high, the more orders stack over it. Here is a real one. In April 2024, near its all-time high, Bitcoin had left an obvious ceiling around $72,000, so a shelf of buy-side liquidity rested just above it. Watch price reach up for it. It spikes above the ceiling, pokes to a fresh high, tripping every stop and filling the breakout buyers right at the top. That is the grab. Then it rejects and falls about 14% over the next couple of weeks. One honest caveat: because crypto trends up over the long run, these upside sweeps are less reliable than the downside ones. A sweep fighting the bigger trend is the weaker bet. Now put them next to each other and the whole idea clicks. On the left, sell-side liquidity. The stops rest below the lows, price sweeps down to grab them, and the real move is up. On the right, buy-side liquidity. The stops rest above the highs, price sweeps up to grab them, and the real move is down. Look at the symmetry. In both cases, price reaches toward the obvious pool of orders, takes it, and then travels the opposite way. So the practical takeaway is simple. When you spot an obvious low, do not be shocked by a sweep below it before the bounce. When you spot an obvious high, expect a poke above it before the drop. The liquidity gets taken first, and the real move usually follows in the other direction. Two mirrored patterns, one underlying mechanic, orders resting, price reaching, then reversing away from the pool it just consumed. Once you know the shape, you see it everywhere, so let us flag them honestly. Here is Bitcoin over several months with every liquidity sweep marked automatically, each spot where price poked below an obvious low and closed straight back above it. Notice two things. First, how often it happens. This is a genuinely common event, not a rare secret. Second, and this is the honest part the course sellers skip, not every sweep reverses cleanly. Some grab the stops and rip higher exactly like the textbook. Others poke below, bounce weakly, and roll over anyway. The shape flags a moment worth your attention. It is a location, not a guarantee. Keep that word in mind, because it is the whole difference between reading these charts sharply and fooling yourself. A pattern that appears constantly cannot, by definition, be a magic edge on its own. What matters is what surrounds it, and that is exactly where we go next. A sweep on its own is only half the story. Where and when it happens is what separates a high-quality one from noise. Three things stack the odds. 1. The more obvious the level, the better. Equal highs or equal lows that everyone can see, or a big round number like 30,000, hold the most resting stops. 2. Trend direction. A sweep of the lows that fires in the direction of the bigger uptrend is far stronger than one fighting a hard downtrend. 3. The reaction. A real sweep reverses fast and closes back through the level on the same candle or the next. If price pokes below and just keeps bleeding, it was never a sweep. It was a genuine breakdown. Level plus trend plus a fast reclaim. That is a quality sweep. Miss any one of those and you are not reading a sweep. You are drawing a story onto a random wick. Let us test each one on a real chart. So, what separates a sweep worth trading from noise? 3 things, and let us see each one on a real chart, one at a time. The first is the level itself. The more obvious it is, the more stop losses pile up there, and the better the sweep. Here is real Bitcoin through 2023. Look at this level around $26,000. Price does not just touch it once, it taps it again and again, month after month, roughly 8 separate times. A level that obvious is one everyone can see, so a huge shelf of stops builds up right beneath it. That is the kind of spot a real sweep happens at, not some random wick in the middle of nowhere. Rule 1. The more obvious the level, the more it matters. Keep that image of 8 taps in your mind, because it is the raw material every genuine sweep is built from. The second thing to check is direction. Is the sweep firing with the bigger trend or against it? A sweep of the lows in a market that is already climbing is swimming downstream, and those are the ones that pay. Here is real Bitcoin in late 2024, powering upward toward a fresh all-time high. Right here, in the middle of that uptrend, price dips down, sweeps a low and grabs the stops. And because the bigger trend was still pointing up, it simply reverses and carries on higher, right along with the trend. A sweep with the trend behind it has the wind at its back. The same shape fighting a hard downtrend is a far weaker proposition, and you saw why earlier. Crypto drifts up over time, so downside grabs align with that drift. Rule 2. Trade sweeps in the direction of the bigger move, not against it. And the third, the most important tell of all, how fast did price reclaim the level? A genuine sweep pokes below and snaps straight back above, often within the very same candle. Watch this one on Bitcoin in mid-2021. Price stabs down, poking a good few percent below the level, and then, before the candle even closes, it reclaims and shoots back above. That instant snapback is the fingerprint of a real sweep. Now contrast it with a breakdown. If price pokes below and just keeps bleeding, never reclaiming, then it was never a sweep at all. The level simply broke, and you do not buy a breakdown. This is the tell that saves accounts, because it forces you to wait for proof instead of guessing. The reclaim is the market confirming the grab is finished. Rule 3, no fast reclaim, no sweep. Level, trend, reclaim. Now let us grade 2 real ones together. Let us slow right down and grade 2 real sweeps on Bitcoin, side by side, because seeing it beats memorizing it. Here is the spring of 2021. Start with the first sweep in late April. Test 1, an obvious level? Yes, price dips into a clear low that had held before. Test 2, with the bigger trend? Yes, the market was still grinding upward. Test 3, a fast reclaim? Yes, price snaps back above on the very next candles. 3 yeses, a high-quality sweep, and it duly reverses and runs about 12% higher. Now slide across to May, weeks later. At a glance, it looks identical. Same dip, same reclaim. But grade it honestly. The level is there, fine. But the trend had rolled over into a downtrend, so test 2 fails, and the reclaim is weak. It does not hold. 2 tests fail, and instead of bouncing, price collapses about 30% in just 10 days. Same shape, opposite grade. Never trade the shape, grade the context. Here is the honest answer, and it is not the one the course sellers give. We flagged every liquidity sweep across 8 years of Bitcoin and tested it properly. Not at one flattering moment, but across every horizon from 1 day to 2 weeks. The truth? After a sweep, price was higher somewhere between 46 and 57% of the time, depending on the horizon. About the same as a completely random day, roughly 53%. And on average, buying right after a sweep actually did a touch worse than buying on any random day, because Bitcoin drifts upward over time regardless. So, let us be blunt. On its own, a bear liquidity sweep is a coin flip. It is not a signal, it is a location. It tells you where the interesting action might be, nothing more. Its only real value comes from the context we just graded, an obvious level, the trend, a fast reclaim, and strict risk control. Anyone selling you the raw sweep as a money printer is selling you a 50-50. So far, you can spot one. Here is how traders turn it into a concrete plan, honestly. The setup has 4 simple parts. First, the level. Mark an obvious low where liquidity is resting, ideally in the direction of the bigger trend. Second, the trigger. Do not guess the bottom. Wait for price to spike below that level and close back above it, the reclaim, because that close back is your real signal that the grab is done. Third, the entry and the stop. You enter on that reclaim, and your stop goes just beyond the low of the sweep, because if price trades back under there, the setup has failed, and you want out cheaply. Fourth, the target. Aim for the prior swing high, which usually gives you roughly 2 times your risk. That is the whole plan. But keep it honest. This is a plan, not a promise. On its own, a sweep is close to a coin flip, so the discipline around it is the only edge that lasts. 3 honest rules, so this makes you sharper, not reckless. 1. Mark the obvious liquidity first, the clear equal highs and lows and the big round numbers, because that is where the stops and the sweeps will be. 2. Wait for the reclaim. Do not guess the bottom. Let price actually spike below and close back above the level before you act. Catching a falling knife because it should sweep here is how accounts die. 3. Place your own stop with room. If everyone's obvious, stop is just under the low, that is exactly where price is drawn. So give yourself a little more space, or you become the very liquidity being hunted. Levels, patience, and a smarter stop. That is the whole game. None of it removes the 50-50 base rate. It simply tilts you toward the setups where context, not hope, is doing the work. You now understand liquidity the honest way. Resting stop orders that pile up beyond the obvious highs and lows, the sweep that spikes through to grab them before reversing, how to spot real ones on Bitcoin, what makes them high quality, and the truthful data on how small the edge really is. No secret smart money cabal required, just a clear-eyed read of where orders rest and how price reaches for them. Keep it honest. This is one lens on the market, a way to read intent, not a crystal ball. The numbers said a bear sweep is a coin flip. The value lives entirely in the context around it. This is educational analysis of historical data, not financial advice. Always do your own research and manage your risk. If a calm, data-first look at how markets really behave is useful to you, consider subscribing, and we will keep letting the numbers speak.